We also know that the consumer saving rate has dropped to 5%. Now, it was in the, I can't remember the exact number, but I think in the spike it went to somewhere in 20% when no one could spend any money during the early days of COVID. Now we're down to 5%. And we haven't been that low since, I believe, 2009-10. So a lot of people are using this, hey, because of all the stimulus out there during COVID, there's still $3 trillion worth of a buffer. You can make that same statement when you're talking about consumer net worth. Consumer net worth is $130 trillion. What that means is assets, so stocks, bonds, houses, and other longer-lived durables, like cars, minus liabilities, how much we owe. And that's 130 trillion. And that's been going up regularly. It gets knocked during recessions. It's being knocked a bit right now. But that's a huge buffer too. So I think that, and that narrative seems to be making the rounds and fueling this idea that the consumer is going to continue to spend. Well, if you look at good spending, the consumer, in real terms, the consumption of goods is down and has been falling for the past year. And it's still above the trend that was in place pre-COVID. And the inventories are massive. Nancy Lazar at Piper does a seasonal adjustment of company inventories. And if you look at Walmart, again, one of the best managed companies in the world, its inventories in the July quarter did not go down. They did not go down. And we had already said, oh my gosh, they're swimming in inventories. So I think they're going to have to start slashing prices to get the consumer to bite. Okay, on to inflation as part of the economic indicators. Got a lot of reinforcement, the Fed did, from the headline numbers, which again may be distorted one way or the other. PCE deflator, which the Fed pays most attention to this, down 0.1% month to month in July. So that's deflation. The core rate, which they pay more attention to, again, taking out food and energy, as I mentioned before, was up 0.1% and has dropped from 5.3% in March to 4.6%. Again, they are looking at 2% vis-a-vis that number, so 4.6% to 2%. We believe, based on the early indicators of inflation, that we're probably going to fall close to 3%, could be below, by the end of this year, early next year. So the fact that we will have gone down from 5.3 to 3-ish%, I think will mean something to the Fed. Again, the commodity prices, the pipeline says deflation is the order of the day.